right now presents one of the most remarkable chances of our generation for anyone who has even a modest sum tucked away, to multiply that into life-altering wealth. You don't need to stake everything on a fickle memecoin hoping for an improbable 100x or 300x surge, nor is it necessary to possess extraordinary intelligence. The method I'll share is straightforward. It's a repeatable process that I've refined over 8 years and through 2 complete crypto market cycles. With it, I gradually grew my portfolio into 7 figures by age 27, investing relatively small amounts along the way. What follows is a practical, step-by-step framework to help you do the same. First, it's vital to see past the current negative headlines and alarming sentiment. Whenever crypto markets tumble, pundits declare the cycle dead only to be proven wrong once fresh momentum arrives. By identifying objective, data-driven signals rather than reacting emotionally to every news flash, you will spot the opportunities others miss. Although this cycle may manifest differently than previous ones, price behavior over Bitcoin's history follows a remarkably consistent sequence, driven by its 4-year halving schedule and by capital flows driven by global liquidity trends. Bitcoin's price unfolds in phases that align closely with the moments when miner rewards are slashed in half. Looking back, the first major cycle lasted about 532 days from the reward reduction to its peak in late 2016. The second halving in May 2020 led to another peak roughly 532 days later in early 2022. The most recent halving in April 2024 tells us that if Bitcoin completed its cycle on the same schedule, late October of 2025 would mark its next high. Even if we don't land exactly on that date, the brevity of this cycle compared to earlier ones signals strong underlying momentum. It means Bitcoin has paired with global conditions so powerfully that even with diminished headlines and apparent disinterest, price remains near its all-time high. The most critical force behind these cycles is not technological development or hype, but global liquidity, the total supply of capital governments, central banks, and institutions inject into economies. Liquidity is the fuel for asset inflation. As central banks expand their balance sheets and interest rates drop, borrowing becomes easier, and asset values rise to reflect the weakening currency. After the 2008 crash, massive quantitative easing drove the S&P 500 up roughly 400% over the next decade. In 2020, pandemic-era stimulus again set off a dramatic run in equities, and for the first time, Bitcoin soared nearly 500% within a few years once that liquidity wave enveloped crypto markets. Today, global liquidity faces downward pressure from rising interest rates and geopolitical tensions, including escalating trade conflicts. But history shows such periods of uncertainty often precede another round of capital injections, when markets risk nosediving too far. Unlike in previous crises, crypto now enjoys far greater mainstream adoption. So any fresh liquidity flood could supercharge cryptocurrency markets even more than the last time. Moreover, when large economies such as China experienced turbulence, recall the 2015 currency crisis, the Ukraine war's capital flight, or the recent yuan sell-off, investors seek safe havens. Traditional stores of value like gold hold trillions in market cap but lack portability. Bitcoin's comparatively modest $1.8 trillion market cap leaves ample room for a 10-fold or 20-fold increase and still remain below gold's valuation. As fear mounts and uncertainty spikes, capital reallocates into non-sovereign, digital assets, presenting some of the most fertile buying grounds in crypto. Recognizing this dynamic, I track liquidity indicators alongside Bitcoin's long-term price patterns, employing tools such as trend-based Fibonacci extensions and Elliott wave counting. These techniques reveal typical 5-wave cycles, where the first 3 waves establish a clear uptrend, the 4th digests gains, and the 5th rockets prices toward key retracement levels, often around 1.618 or 2.618 Fibonacci extensions. In the current cycle, Wave 3 has already reached the 1.618 extension, and we've only just begun Wave 4. When Wave 5 unfolds toward the 2.618 extension, Bitcoin could test 6 figures and beyond. Beyond timing the top of Bitcoin's rally, True wealth acceleration comes from harnessing compound growth. Traditional assets like stocks and real estate yield annualized returns of around 8 to 10% over decades. By contrast, Bitcoin has averaged roughly 78% compound annual growth over the last 10 years. Even if that rate tapers, conservative modeling that assumes 35% annual growth over the first decade, then 20% over the next, and eventually normalizes to 8 to 10% could turn a mere $1,000 initial investment, supplemented by modest annual contributions, into well over $1 million in 30 years. Redirecting some of this capital into select altcoins during market lows can multiply those results dramatically. To implement this, I break investing into two portfolios: a core portfolio focused primarily on Bitcoin, and a high-risk casino portfolio for smaller, higher-potential tokens. Consistency and discipline are paramount. Commit to a fixed monthly contribution. Reserve a portion of your funds to deploy selectively during market corrections and avoid emotional whipsaws. For example, you might contribute $1,000 per month, setting aside 10% for opportunistic buys during deep dips. Of the remaining $900, allocate 75% or $675 to your core holdings, with the rest $225 divided among the high-risk altcoins. Adjust these percentages to match your risk tolerance, but always maintain the discipline to stop accumulating altcoins as Bitcoin approaches cycle highs. Within your core portfolio, consider a spectrum of market cap-based allocations. Bitcoin's liquidity and size make it the lowest risk, while major platforms like Ethereum or Solana form a medium risk tranche. If you prefer a conservative approach, keep core nearly 100% in Bitcoin and gradually introduce smaller allocations only after you've amassed a significant Bitcoin position. When it comes to high-risk altcoins, research early-stage projects with unique value propositions. Real-world asset platforms, decentralized AI protocols, and on-chain data indexing solutions stand out as some of the most promising niches. Ono Finance, for example, aims to become the institutional bridge for tokenizing tangible assets on a layer 1 blockchain. Its current $2.9 billion market cap implies that capturing a mere 1% of the nascent real-world asset market could send it into the tens of billions. SubQuery, a decentralized data indexing network, is equally compelling. Projects like Snowflake dominate this space in traditional tech, and crypto counterparts could easily scale from a few $100 million to multi-billion-dollar valuations. Grass Protocol taps into unused computing resources for data scraping, offering early investors potential tenfold returns if cloud compute demand accelerates on-chain. And DAO, a decentralized AI chat protocol, combines machine learning and blockchain in a way that could mirror Check's growth trajectory if adoption picks up. For each high-risk position, size your exposure so that even a total loss will not derail your overarching plan. If only 1 out of every 10 picks becomes a home run, your core portfolio's compounding provides a safety net that lets winning trades multiply account value substantially. Whenever Bitcoin prices reach terminal extensions or global liquidity indicators peak, systematically harvest gains from altcoins and rebalance your portfolio back into core holdings. Repeat this buy and sell discipline through each cycle. Over multiple 4-year epochs, the mathematical force of compound growth combined with occasional outsized altcoin successes can transform small starting capital into life-changing wealth. By sticking to this framework, buying consistently, preserving capital during rallies, and capitalizing on fear-driven downturns, you sidestep both the pitfalls of trying to time tops and the folly of all-in memecoin gambits. You'll never wake up to, "if only I had," regret, because you'll be building steadily, deploying extra reserves when markets are discounted, and letting profits compound when they soar. This is the method I employed to reach 7 figures well before my 30th birthday, and it has the power to change the trajectory of your financial future if you apply it with the same patience and rigor. The opportunity is here. The world's liquidity engines are primed to fire again. Crypto adoption is surging, and the stage is set for another historic bull market. Remember, Every multi-trillion-dollar asset class, from housing to stocks to gold, once started as an undervalued innovation. Crypto is no different. Now is the time to act, build your process, and let compounding do the rest.